Hi everyone, I'm Eudora from Deals Through Asia. It's my great pleasure to be the moderator of this panel. It's about China private equity. We've done summits in Singapore and Jakarta that's China relevant before, but this is our first time doing a country-specific, China-specific panel here. And I have here with me 4 dedicated speakers with China investments, as well as regional and global allocation. So, last year was clearly a better year for private equity in China, and moving into this year, IPO market has been doing great. We're hearing a lot of discussion in this market saying that China P is coming back, but is that truly the case? I'd love to hear some of the on-the-ground reviews. Maybe each one of you, on the macro view for China, PE fundraising, do you think the market is coming back? Any of the key trends you're observing when it comes to China-specific fundraising? Maybe we'll start with you, Kent.
Thanks for having me here. Ken Chen, Managing Director and Head of Asia Private Equity at Neuberger. For those who are not familiar, Neuberger Berman is a global investment firm with AUM over $550 billion US across fixed income, equity, and private markets. And I oversee the firm's Asia private equity investment from Japan, Korea to China, Southeast Asia, India, Australia.
Yes, and then Gary, please introduce yourself as well.
Oh, thank you for having me. So I represent Sun Hung Kai & Co. We are an alternative investment platform. We have a few strategies: private equity, private credit, hedge funds, public equities, and we also seed asset managers. Our capital is first and foremost from the balance sheet. We also deploy on behalf of third party. Of the 5 strategies, private equity is the most prominent, is the largest. And then within private equity, we do fund investments, which basically gives us our beta. We kind of look for 2 times from our GPs. And then we do co-investments and direct investments, which is our alpha. So we invest globally, but China and US are our 2 biggest markets.
Thank you. And Alex, over to you.
Hi, Alex Ying. I'm representing CDIB Capital. I head up the direct private equity practice. CDIB is part of a Taiwan kind of conglomerate under KGI Financial Holding Company, which has a bunch of different financial services. CDIB Capital is one of the subsidiaries that focuses on private equity. And I myself focus on mid-market buyouts in Greater China, leveraging a lot of the Taiwan ecosystem for businesses that are in China and helping them to transform into sort of regional champions going into Southeast Asia and so forth. But we basically, we're very focused. We focus on advanced manufacturing sector across the sort of the Greater China landscape. And a lot of times it's generational transitions, sellers that want to, sell the business, kids don't want to take over. So that's kind of our pocket and sweet spot. That's what we focus on.
Jacqueline.
Great. My name is Jacqueline Zhang. I represent Hopeful Capital. So for those who may not know, Hopeful is one of the largest sort of Asia-based private equity managers. We have over 25 billion of AUM, including a lot of co-invests we generate for our LPs, who I see some of you in the audience. So for us, obviously, we have our origins in China, and then we continue to do a lot of deals there, including the control types of deals that we're increasingly seeing, which will be a topic that will be great to explore a little bit more. But we also do, I think, starting a long time ago, right? A lot of cross-border deals where we create more proprietary situations to leverage the China angle to get into global assets and vice versa. So, definitely interesting to talk about how, against this more complicated backdrop of what's happening globally, what types of deals we're seeing.
Thank you very much. Let's start from this very start about fundraising in private equity. So after a few turbulent years, we've seen fundraising that's for a China mandate coming back to the market. Do you see that momentum from last year coming into this year as well? So from LP's perspective, let's start with Gary and Alex.
Sure. So from our perspective as an LP, definitely in the last 12 to 18 months, through our doors, we are seeing a lot more Chinese GPs. And so for us, we have quite a portfolio already of Chinese GPs. And then for us, the way that we think about it is first and foremost whether we want to re-up with those Chinese GPs. Within our portfolio, I would have to say that there are some GPs that are doing extremely well in the China market. So, for example, one of them is Black Ant Capital. They are a consumer fund. We've known them for a while. It's a small team. We invested with them in Fund 1. Some of you may know them as being shareholders in companies like PopMart, Laopu Gold, Mingming, and so forth. So they've done extremely well. That fund has returned 1 times for us within 4 years. And so recently they recently closed their fund to not a big size, about 200 million, which we liked. It meant that they're very focused in their sector. And for that one, we re-upped. And then from what I hear from them, it was very much oversubscribed to the extent we were cut back on our allocations by more than 50%. So we're very, very happy for them. There are also some VC and tech Chinese GPs that we've met with. And from what I understand, they've also done very well on the fundraising side. I think folks like Lanqi Ventures, Yunqi, I think they're very, very good. So definitely we are seeing a lot more activity, but I would say it's very selective. At least from our side, when we re-up or when we invest, we are very selective in who we invest with.
Thank you for the examples. Really appreciate that. I'd like to hear from the global LP's perspective. Kent, from a Neuberger's point of view, you guys invest globally, and with your focus, I think a few years ago you mentioned about how India, China, and Japan are the 3 locomotives in Asia. And in this year, from your side, building the Asia portfolio for a global company, what is the weight currently carried by your exposure to Greater China?
Thanks for the question. In the ideal world, of course, we are not living in the ideal world now. In the ideal world, China accounts for about half of the Asia private equity market, right? And Asia private equity market accounts for about 15 to 20% of global PE market. So that's the ideal world if you have an equal market weighting, right? But in this bipolar world or uncertain world, right, there's no one-size-fits-all solution for every investor, right? So we offer solutions to help investors, right, customize their strategy, right, in different parts of the world. So China, I think we still like China, just like I liked China 3 years ago. So I started my career as a sell-side equity analyst. I remember every day I arrived in the office at 7:30 a.m., flipping through all the major newspapers, looking for company announcements, Bloomberg, and need to adjust my recommendation whether to buy, sell, or hold, right? And if I don't change my recommendation for 3 years, I probably lose my job. Right? But we are in the privileged position in this room, involved in private market where we can afford to have a longer term horizon. Right? So China, just like I have been saying in the last decades, and most recently last 3 years, we like the valuation, right? Because of the macro headwinds, right? China economy have gone through basically all sorts of stress tests that you can imagine, right? From trade war to COVID, right? To policy reset internally, right? And then to sanctions, Ukraine war, right? Iran war, all sorts of a challenge. So the public market and private market valuation has come down and is nowhere near the peak, right? So from a valuation point of view, this is still an attractive moment to look at China. At the same time, the new growth drivers, right, are coming up, right? We can talk about this for the whole day, right? Digital economy, green economy, right? Advanced manufacturing, right? And AI, robotics, we can go on and on. So the China tech sector is at an inflection point, right? So you have a bit of a value and also growth within China. So that's what why I like China. So yeah, we remain very interested in following the China market.
It's interesting that Ken, you mentioned ideally China should be 50% of Asia portfolio, and then Gary said selectively returning to Chinese market. We very much observe the similar trends on the editorial front, Deals through Asia. So this next question is for Jacqueline and Alex. I wonder, since we are looking at a market with reviving interest in China, but when it comes to actual capital deployment, it has not been that significant. What do you think could perhaps move the needle in the next half of this year? What are the opportunities that will interest the LPs of your global LPs and the other China-specific opportunities versus other Asian markets? Maybe we start with Alex.
I think, as we were talking about earlier, China is definitely picking up. There's been more activities, more fundraising. What would move the needle, in my opinion, is that people would like to see a bit more exits, full deal returns. Given that what it's gone through, I remember the last 3-4 years has been quite painful. I don't know about Jacqueline's business, but it is just slow in terms of LPs or other folks that I talk to. People don't believe that you could make returns in China anymore. It was at that, and so I'm very happy that there's been a bit more exits from, at least from our portfolio, and I'm sure others as well. And I think having more of that, people will start to come back more, which seems to be happening now.
Exit, liquidity, important factors. And Jacqueline, what are the opportunities? Where to invest?
Yeah, I would say, first of all, on the exit front, right, LPs definitely very focused on DPI. So, for us, obviously we have our origins in China, but if you look at our sort of revenue exposure across our portfolios, it's half China, half ex-China. So let's say last year, right, we understand the LPs really wanted to see money return. Gary touched upon that. You're always happy as an LP to get a check, in your bank. So for our latest fund of 2.6 billion, we returned over $1 billion last year. But that's for the first half of the year. To be frank, it was actually from our ex-China portfolio. And then starting from the second half, you're starting to see more China, sort of going out of the J curve a bit more, and then continue to see monetization opportunities this year. So I think really you have to, if you're 100% geographically concentrated, yes, sometimes you do see these bumps and uncertainties. But I think as LPs do see real capital return to them, that's always, for us, it's always, the best way to ask for a check is by returning them the one in the first place. But I also think what's moving the needle is, when you do have very compelling situations, LPs are always very happy, excited, right? But I think maybe there are two types. One is certainly China's making great strides in technology. I feel every time you talk to even a US investor or business owner, there's not a time when they come to China to visit, they're not like wowed, right? And they're always reflecting on how to make changes to their own businesses, right? So of course you have this dichotomy of capital being still kind of dried up versus the massive sort of development and just the operating efficiency at scale and the level of innovation you're seeing in China on the ground. So there's definitely a dichotomy there. But also for what we do, we're very excited by a couple of types of opportunities. First, as Alex alluded to earlier, right, there's definitely a lot of succession sort of driven buyout opportunities that's coming out of China, right? China's corporate landscape is still relatively young, but then for the first time, maybe for the past, say, 2 decades that I've been in China private equity, you're seeing good businesses coming out for sale, right? That's number one. And number two, we really like, the types of cross-border opportunities where you can create more proprietary angles to basically return to the more classic PE deal making, right? Because in the end, that's where you get your returns, right? Through access to structuring deals, et cetera. So, we're especially for what we do, obviously MNC carve-outs, if you can really identify good businesses and structure, help global business de-risk their China business and revitalize their China business. That's good. But also, a lot of more orphaned overseas assets owned by Chinese companies. To us, that's very interesting as well, right? Because these businesses have good cash flows, but they're in themselves very good businesses. But sometimes they have shareholder overhang, right? But then you also need someone who understands trying to unlock the situation because the seller is Chinese in origin, right? They can't just sell to, especially let's say, if it's an SOE, they can't just sell to Neuberger Berman directly, let's say, right? So that's when you can step in and structure something interesting. So I think when we talk about these more, influential and then kind of slam dunk situations to LPs, they're always very excited.
Are there any specific sectors where you see these opportunities you just mentioned?
I think it's definitely, again, right, you have to, there are many sectors, right? And you have to think about, let's say, for a China origin deal, right, whether China has a sustainable advantage in, right? Either it's advanced manufacturing, certain pieces of technology. We're a majority control owner in ARM China, which is a business we're carved out of ARM Global, which is the global #1 leader in chip IP design. So if you can identify like a dominant monopoly business, they can do a deal, and that's great in technology. But I think really it's businesses where you can find defensible cash flow. That's a long-term compounder, and LP's always very interested.
Fair enough. I'd like to shift to the specific AI sector. So, Gary, you invest in AI both in Greater China and also US. For your primary co-investment, direct investment, how are your strategies for these two markets different when it comes to AI?
So yes, we like every other investor, I think we've been actively looking at tech and in particular in AI. So in the US market, the two big tech markets are the US and China, but we do play it slightly differently. One area where it is common is part of our capital we have assigned as risk capital. So we do deploy a small fraction of our portfolio to some of the more high growth AI companies, for example, like an XAI, an Anthropic in the US, or a Minimax or a Moonshot in China. So we have invested in these companies, and they've done phenomenally well for us, but it's just a small part of our portfolio. In the US, where we have deployed a lot more, and it's kind of at the intersection of AI and also more traditional PE, are some of these AI transformation plays. So, for example, late last year, we were part of a small consortium that took private an asset management company in the US called Janus Henderson. They manage about $500 billion US in AUM. The takeover price that we bought in at was actually quite compelling at around 7 times EV/EBITDA. For those that you may know, asset management in the US, there is a lot of structural headwinds. There's fee compression, there's fee outflows, and so forth. So you're probably asking why would we invest in a sunset industry? One of the key theses in our investment was AI transformation, or basically embedding, in particular, the mid-office and the back office and the workflow processes and the tech stack with AI products and more efficient workflows. So as part of our consortium, there was only about 5 investors in that consortium. It was us, Trian, QIA, MassMutual, and General Catalyst. For those that you know, General Catalyst is more well known as a venture capital firm. So why would a venture capital firm participate in a take private? They were brought in specifically to do the AI transformation. And in a nutshell, the thesis was that Janus Henderson, I mean, it's a great name, but its market share has been under some pressure. Its EBITDA margins, for example, was trading at around 32, 33%. Whereas a market leader, BlackRock, is their EBITDA margins around 45%. So with the AI transformation, we believe we can improve the margins of Janus Henderson from about 30 to 32, closer to where BlackRock is, about 45%. And then with that, cost savings, more efficient workflow processes, I mean, that flows basically to the bottom line. So that's one way we are playing AI in a more kind of traditional PE way in the US market. In the US market, there's actually quite a lot of these AI transformation opportunities, and there's a few others that we're looking at. One that got announced again recently was the take private of Amex GBT, which was again taken private by General Catalyst again, so it's the same thematic, AI transformation. In China, we are looking, but I think it's slightly different. I think it's more tech enablement. I think the McDonald's deal done by I think it was Carlyle and CITIC had that technology thematic or that angle in it that allowed them to do the value creation. So the opportunities in China, we are looking, but it's less obvious to us at this point in time.
I think since maybe second half of last year till the first few months, we've seen several US dollar fundraising successes done by tech-focused fund with a very heavy AI elements. While fundraising is coming back selectively on the US dollar front, we do see the markets becoming more selective. And I'm reading this Bain & Co. report on China PE, which they say 12 is the new 5, which means delivering a 20% plus IR now requires about 12% annual EBITDA growth versus 5% a decade ago. So from the GP perspective, let's start with that. Alex, during your internal investment committee, say you have a deal that potentially you can invest in front of you that's Greater China focused, what is the one main metric or one growth assumption that you would now scrutinize most heavily?
I think we look across at a lot of different metrics. It's kind of a amalgamation of everything. But I do think that the market does need to be more selective now. It's getting more difficult rather than easier. So as your point, 12 is a new 5. I think that's actually a good thing for the industry, as it tells me that it's getting more mature. Because if you just need 5%, then everybody can theoretically do it. And so I still remember back in the days when there were tons and tons of Chinese PE funds, everybody was able to raise money, but people didn't really know what they were doing. So now I think it's a healthier market. I see it as not so much as a headwind, but a moat for the folks that kind of know what they're doing. But I think in terms of the metrics that we look at, the most important thing for us is why are we the right buyer for a particular asset? I mean, every GP has their own kind of thesis and theme and strategy. So what is it about a particular deal that makes sense for us? That's kind of what I tend to focus on. And for us, it's, like I said, advanced manufacturing sectors. And you look at why the current ownership wants to sell and why we're the best buyer for it. If we can feel that that is the case, we're not necessarily competing with a billion other funds out there. We have a special angle. That usually says a lot. Obviously, there's valuation and what's the growth plan and all of that. We focus on all of it. But I think that the main thing is how are we differentiated from other GPs.
Understood. And Kent, from your perspective, now we need higher growth from China to get the similar levels of return we see a decade ago. How does that apply to your GP selection process? Can you help us understand what is the main maybe value creation, operational differences between top tier GPs you're looking at versus second tier?
Okay, let me stay away from China for a moment, using the lesson learned from our experience in working with GPs in other markets, for example. Right. So one of the amazing things I find working with the GPs in Japan. So they are a group of GPs in Japan that I start meeting 15 years ago, right, when I was in another institutions. And fast forward to today, right, despite all the challenges in the Japanese market, right, they have gone through the lost decades multiple times. The same group of GP has been doing the same thing consistently for the last 15 years, right? So some of the GPs focusing on lower middle market, today they are still focusing on lower middle market. GPs who are focusing on mid-market buyout, they are still doing mid-market buyout, right? Despite some increase in their fund size, right? The sectors they focus are all the same, right? Throughout the decades, like consumer, healthcare, business service, right? Industrial, right? All these are the sectors they have been focusing on, right? And today, with the growing popularity of the Japanese PE market, right? A lot of global investors are rushing in and begging for allocation. And the GP said, no, sorry, we don't have allocation because we don't want to substantially upsize our fund, right? Which may fundamentally change their strategy, right? So to answer your question is that the GPs that we like are the GPs who have conviction in their core expertise, their core market. They would know what they do, they know what they can do, right? And stay disciplined, right? Stay the course. So those are the key elements that we like about a GP.
Then I'd be very interested to hear your thoughts on the latest round of fundraising we're seeing in China. So GP fundraising, a lot of them previously may invest in tech in China before, but nowadays, in order to get on the AI bandwagon, they're saying we do AI investment or AI plus consumer, for example. Do you think it's necessary to have that AI element when you fundraise?
So we are open-minded, right? So if there's a certain sector, a certain business which can adopt AI and substantially improve the business, right? We are all for it, right? But we will not go out just say to impose a requirement that every business, every GP need to do AI investment.
Fair enough. Shifting gear a little bit towards policy alignment, given that China is such a policy-driven market, and looking at the latest 5-year plan from the Chinese government, Jacqueline, from your side, where do you think are the policy-aligned industries and that there are opportunities for PEs?
I think generally, obviously that's a space that a lot of R&B investors are very focused on, right? Obviously for us, we're very close to just trying to understand what the policy direction is. But I think certainly there's a strong focus on AI advancement, securing China's supply chain, and making sure top sectors are globally competitive. And I think it goes back to sort of your everyday underwriting, right? Definitely see opportunities as in China sort of taking a K-shape sort of trajectory going forward, right? You have businesses that continue to thrive, either it's enabled by AI or accelerated by AI, but you also have businesses, and China is so competitive, right, in terms of the day-to-day business operations, super optimized. You probably have businesses that will be phased out more quickly than before. So you just have to, for what we do, right, just it's whether it's AI or not, or robotics or not, you have to really think about how your underwriting case is gonna look like in not just in the next 12 months, but 5 years from now, which is I guess going back to your earlier question a little bit, right? It's just it doesn't matter if it's AI specifically, it's definitely gonna transform a lot of industries in China, and you just have to always think about that, given you have to own this business for the long run.
And Jacqueline, just stay with me on this a little bit. Since we're talking about a lot of the policy-aligned industries, we do see enthusiasm, be it RMB, largely RMB domestic investors, investing into these specific areas. Do you see valuation increases Do you see any valuation bubble? Where are the overlooked opportunities still? Maybe undervalued as well?
I think, by the way, like I'm gonna when I go back to office, I'm gonna frame the 12 is the new 5 thing on my desk, because I think to Alex's point earlier, we would love it if every GP raised their underwriting bar, right? It means that there's much less sort of irrational exuberance in the market and so on and so forth, right? And I think on the on the valuation point, the overall there's a short term piece, there's a longer term piece. Short term, you guys also have seen a lot of Hong Kong IPOs. Like, is there a piece that's more narrative driven, not so much the cash flow backed? I think everyone would agree there is. When your average day one IPO debut is up, I don't know, 40%, 50% for all the names on average, right? So there's definitely an element of that. But I think longer term, we're definitely very bullish on China's general direction in terms of, you think about the big the major elements of what makes a strong set of sort of ingredients that will make an investment successful, right? Supply chain security, just the ability to scale businesses super fast, the ability to mobilize even like advanced manufacturing, right? Like labor forces at massive scale, being able to innovate, all these things, and being able to go global. And you continue to see great, consumer and technology businesses kind of coming out of China. So if you take a longer term view, and even if you look at sort of broad market-based indices, right? MSCI China probably still, 30-40% discount than rest of the world, especially compared to developed markets. So there are definitely pockets you can see that for what we do, right? They are overlooked, where you have good cash flow. There are hidden winners in the market you can buy, still at single-digit EBITDA multiple. And not to mention some of the sort of more orphan assets I was talking about earlier, right? These more complicated situations where a PE fund like ours, we can lean into this kind of more complicated situations and negotiate structured investments at low multiples.
Thank you. Just a quick reminder, we do take questions for this panel. If you have any questions, please scan the QR code. So Alex, the next question is for you. Since in your case, the company is dealing with Taiwan, Greater China type of situation, when it comes to policy alignment, how you read into this, perhaps a criteria when you invest in mainland China, how does it apply to your investment strategy?
I mean, fortunately, our investment strategy is simple. Right? We're very focused, as Ken was saying. We're almost exclusively focused on advanced manufacturing sectors. Now, that's a very wide sector. It goes into all kinds of components around manufacturing, medical device, and everything. But I think for the regulatory backdrop, advanced manufacturing is actually a welcome sector for foreign capital, as well as medical device, healthcare services, green energy related investments, and that's sort of what we focus on. If it's something that's very semiconductor driven, that's or data driven, that is more kind of protected by China, then it's probably not the right deal for us to do a buyout on, because we need stable businesses. So I always say that we look at pretty boring businesses. Within advanced manufacturing, there's tons of opportunities, and that's what we tend to focus on.
Fair enough. I think these are the safer bets. Moving on to the exit and liquidity. So I'm looking at the data. Exit last year rebounded. Exit in Greater China market rebounded to $53 billion, reaching its highest point since 2022. And that includes exits via IPOs, but as well as secondary transactions and more. So how do you assess the current PE exit environment? For Kent, please.
So we have a very good year of Hong Kong IPOs, right? But the good year, we only have about 115 IPO in 2025. And now, based on the latest number, I think the IPO backlog in Hong Kong is about 480 to 500, maybe more today, right? So it will take at least 4-5 years to clean up the backlog, right? That's a long time for a GP to get much needed liquidity for their LPs, right? And this morning at the first panel, Joji asked about what's the alternative to GP-led or CV, right? Given that effectively for CV, you are going to the same pool of private investors, right? So what we have been doing, actually I'm putting on my hat as a vice chairman of HKVCA, is that in the last 10 years, we have been lobbying the Hong Kong government and the Hong Kong regulators to allow private equity managers to list their private equity vehicle on the Hong Kong Stock Exchange to help the GPs create liquidity, right? Without the urgency to sell individual assets, right? At the same time, help them broaden their LP base, right? We are glad that to hear that a lot of GPs express interest in this solution and have been in discussion with the SFC for authorization of their private equity vehicle for listing on Hong Kong Stock Exchange. So the approval process is quite different. So for typical IPO of a company, you have to go through the stock exchange listing committee. For the listed private equity vehicle, you go to the SFC for authorization as a unit trust. So the waiting time definitely is not 5 years, right? So hopefully that will help solve the liquidity issue.
It's definitely a very interesting approach. I see a question from the audience that's relevant to Hong Kong IPO. Is the boom in Hong Kong IPOs sustainable? Can you also take this, Kent?
I don't have a crystal ball, but I certainly hope so. And as a global portfolio flow continue to rebalance, I believe that the inflow of capital to Asia and Greater China as a whole should be able to hold up.
Thank you. So maybe for Gary as well, since you do primary fund investment, you have GP partners in China. We are looking at an estimated $12 trillion exit backlog in Greater China. Do you see any GP-led secondaries becoming more mainstream comparing to IPO as a way to generate exits for LPs?
Yeah, so as an LP, we welcome various tools that the GPs can use to affect an exit, a divestment, and effectively a liquidity option for LPs. So we welcome GP-led secondaries or LP-led secondaries. So certainly in the last 12-18 months, we've been seeing a lot more activity in GP secondaries, and I guess that's a function of the market whereby a lot of the assets aren't able to exit, whether it's an IPO or an M&A, and therefore the GP-led secondary becomes a useful tool. We're seeing that a lot also in the US. In fact, I was just in the US in the last couple of weeks, and I had a number of GPs that had GP-led secondaries approach us to take a look at their strategy. So that tool is now quite mainstream in the US, and it looks like it's becoming more mainstream in China. For us, again, we're very selective. I mean, GP-led secondaries, there's perceptions of you're doing it because you can't get a proper exit, but indeed there is also some situations where the underlying asset is very, very good, and the GP wants to hold onto it for a lot longer. As an investor, we just need to determine which side of the fence that particular opportunity is at.
It's definitely a fair point. Yesterday, when I was at HKVCA's, one of the panels in the afternoon mentioned extensively around China discounts in the secondary market. You look at opportunities both in China and US. How do you view these different narratives? For Western investors looking at secondaries, there's a discount for China portfolios, but vice versa as well when you go to a market that's not your home market.
So I mean, we invest in secondaries. We do look at LP portfolios, both in the US market and the China market. We also have GPs that help us in that process. For example, we are LPs, I think, with Collar, with Clipway, with Stepstone. So we do use their database a lot when we look at the portfolio and we look through to the underlying companies. So we do have situations where people come to us with a China portfolio and say, oh, you know, this is at a 50, 60, 70% discount. That frankly doesn't mean that much to us. I mean, we do look through the portfolio, and whether it's our own database or the database of our GPs, we do know the underlying companies and what they're really worth. So we do quite a granular exercise. I would say the secondary market in the US is quite efficient. So what's presented to us actually is pretty tight. It's like market discounts, whereas the ones in China, we do need to do a lot more work to see whether it really is worth those type of big discounts.
Thank you for sharing on the front. Shifting more to buyout, since Hopepool and also Alex, on your front, you do a lot of cross-border buyout deals. I have a question here from the audience. Are there legal or regulatory hurdles for Taiwanese GPs when doing buyouts involving Chinese companies? And we've seen the latest Beijing's veto of the Meta Manus deal, and that sends a clear message, even though you are a Singapore registered company, as long as you're dealing with Chinese tech or Chinese funders, you may still subject to regulations. How do you answer this one?
You know, I think in terms of regulatory hurdles, it's actually quite good for Taiwan GPs. Because of political backdrop, I think Chinese, China looks at Taiwan as a bit of a, special category, friendship and so forth. So we actually find that to be a very healthy kind of relationship. In fact, we have a number of R&D funds in China as well, set up with local governments. So I think it's, no issues, at least as far as what we do. Advanced manufacturing, it's well supported, it's very positive. I'm not going to look at really data sensitive businesses anyways, so I haven't tested that, but everything else what we do is quite good.
Fair enough. And Jacqueline, over to you. When I did this interview with your partner, Gunther Ham, and he mentioned how Asia's golden first wave for control investing is here. But unlike many other mature Asian buyout markets like Japan and Korea, the market in China is still very much developing. Where do you see preparatory and reasonably priced control opportunities in Chinese market?
I think the returning back to a couple of categories I was alluding to earlier, right? You want to, I think in China there are certainly a lot of the recent young businesses. They're if you look at the headline valuation, right, it's pretty rich. But there are pockets of the economy where you can definitely find hidden winners, whether they're facing succession issues or it's again, right, MNCs carving out their business in China. And they're looking for in a non-bidding situation, right? They want a local partner that can help them navigate and de-risk the business. And then business operations in China, right? If you're a global MNC CEO, if you look at your China portfolio, if it's growing very fast, you actually get a little bit worried, right? Whether you can secure the growth of that business if you're owning it 100%. So you definitely see more and more of these carve-outs domestically, and that's definitely a pocket of opportunity we're leaning into. And then we are also very bullish, as I mentioned earlier, right? We definitely see massive opportunities in sort of the reverse carve-outs, i.e. you're looking at more orphan assets owned by Chinese companies, right? These situations need to be unlocked by private equity funds that know both sides, and these tend not to be very market-driven situations. So when you think about, well, for what we do, when you think about deal making, right, you need to lean into more complicated situations to create more proprietary deals, and that's how you get more attractive deals at cash flow rich, the compounders at below 10%, 10 times P. So that's the types of deals that you really like. So just to give you a few examples.
Thank you very much. We're running out of time. One last question to wrap up the panel, more forward-looking. Looking into the rest of this year, perhaps the next 3 years as well, what is the one structural change in China's PE market that global investors should not ignore? And how do you navigate it? It can be an opportunity or it can be a challenge. Maybe we start from Kent and we go this way.
Well, I think I have been talking about the importance of the service sector. So everyone is focused on AI, robotics, and all that, digitalization. But I think one area which is highlighted in the 15th five-year plan is the importance of the service sector. If you look at the cross-country numbers, service sector accounts for about 55% of the Chinese GDP, whereas in US, Germany, Japan, it accounts for about 75%. So there's a big gap, which means big opportunities for our private equity peers and GPs to explore.
Thank you very much. And Gary?
So I think in China there are some sectors where I think there will be global champions, and therefore that's what we look for. So sectors like robotics, EV, biotech, advanced manufacturing, and even AI. So we do look for those, but we're very selective. And I think what I would like to, we're happy to pay, valuations which seem quite high for those global champions, but we do also want to see profitability and revenue go into those valuations.
Alex, please.
I think one of the things that is slowly starting to happen is as founders mature, they're more willing to sell businesses because they're retiring. Now it's a long process for Taiwan founders. They're all 70 years old, and clearly, under the current environment, many of them I see they just say, well, I made enough money, I'm going to sell the business. Had enough of it. It's a crazy world. Whereas in China, the entrepreneurs are still younger, but they're getting older. They're getting there. So I think in the next 5 to 10 years, there will be more that are genuinely thinking that they are retiring. They're not just selling you a bad business. They're generally thinking that it's a good business, but they want to retire. So I think that's continuing to happen nowadays.
Thank you, Alex. And Jacqueline?
I think maybe for the first time in a long time, you will see real sort of classic PE deals come out of China, right? Maybe similar to Japan, hopefully, right? 7, 8 years ago, you have, good businesses going through transitions, and you have, super low, bond yield and cheap debt, right? And then you do have businesses that can not just capture China, which is intrinsic, sometimes a very competitive environment, but also going global. So these are all ingredients for a successful buyout. So we're very hopeful.
Thank you very much. With that, we will conclude this panel. Thank you very much, everyone. Round of applause to our speakers.
Thank you very much for your insightful dialogue in China.